I'm Eric Green, partner at Green and Sklar's, a boutique tax law firm and founder of the tax resolution training organization, Tax Rep LLC. Welcome to another edition of Tax Rep Network podcast. I want to thank our sponsors, Tax Help Software and Call ENQ. We've only taken podcast sponsors of products that we actually use at Green and Sklar's. Call ENQ is what allows us to call the government and get into the IRS in under 3 minutes. Tax Help Software is what we use to pull transcripts. It's our intelligent ordering where we track what's going on with our clients overnight. So in the morning, we know of anything that's happened on the IRS side, and also what we use for our resolution forms, our offers, installment agreements, uncollectible powers of attorney, all of that. Our sponsors have special offers for you. If you want to check them out, go to taxrepllc.com, resources, and TRN podcast page to view the sponsor offers. Enjoy the episode. All right, everyone, thanks for joining us again. Joining me is my friend, Megan Brackney. Megan is a partner at Kostelanetz and Fink in New York City. In fact, I actually remember when she became a partner, I think we were at an ABA meeting.
Yes, we were.
And I was outside and someone said, Megan just became a partner, and everyone was congratulating you. But if you don't know Megan, she does civil and criminal tax controversy work in New York City with Kostelanetz and Fink, although has cases like all of us kind of all over the place. Prior to joining Kostelanetz and Fink, she was a assistant United States attorney in the Southern District of New York. She was also an assistant attorney general for the state of Missouri prior to moving to New York with her husband. She is recognized consistently as one of the New York super lawyers and Invest and all the other places you can be recognized. And she speaks all over the place and has written extensively on tax controversies, I believe matrimonial and divorce issues, immigration and tax issues. It's not hard to find Megan if you are interested in getting a hold of her. So Megan, listen, as always, thanks for taking the time and doing this.
Thank you for having me.
No, I think this is a great topic. You know, the Form 8300, which I'll be honest with you, I first learned about, it might have been you and Mike Villa. I'm going way back in my memory banks at an ABA civil criminal tax controversy, the Civil Criminal Penalties Committee reports. And for those of you who are not attorneys and part of the ABA, the Civil Criminal Penalties Committee does update reports. And I remember sitting there and you and Mike, I'm pretty sure it was you and Mike.
That sounds familiar.
Yeah, talking about, Mike's been on the program before. In fact, we just did a program on whistleblowers. And I remember thinking, I'd never had an 8300 issue come into my office. And interestingly, you guys spoke about it. And then I got one. It was a used car dealership. Got audited. It was a quote unquote Bank Secrecy Act audit, which I didn't know what the hell that was either. And so if you don't mind, can you give the audience who is not familiar with this, what is the 8300, and why is it important?
Definitely. So the 8300 is a form that reports the receipt of cash payments of over $10,000 received in a trade or business. And as you mentioned, it can be administered under the Bank Secrecy Act, but also under the Internal Revenue Code. So it's an odd IRS form that's both an IRS form under Title 26. The implementing statute for those who are interested is 6050I. But it's also a form that FinCEN, the Financial Crimes Enforcement Network, enforces under 31 USC 5331. And so when you have an 8300 audit, it can either be an audit under the code or an audit under the Bank Secrecy Act. And we'll talk as we go about some differences in the outcome, depending on whether it's a Bank Secrecy Act audit or an IRS audit. But in any event, essentially what the form is it's a way for the IRS and Treasury to track cash transactions that occur in the United States. And so as the form indicates, if you receive more than $10,000 in a transaction or related transactions in a trade or business, the business is required to file this form and take some other steps related to compliance under these statutes.
Yeah, and for those people, for folks listening, to me, and this is one of those weird things I thought of one night while I was sitting out in the backyard, probably having a drink, was, the IRS, the government, has really put on an attempt to kind of get its arms around the entire financial picture. So you have the 8,300, you have FBARs, you have all the information coming in from FATCA. We are watching them now go after Coinbase and Kraken and Circle and the other virtual currencies. And so much of this, I think, is to try to track the money. After 9/11, you realize, hey, it's easier to go after the money than send special forces to chase guys around in caves. The 8,300 has been around a while, but it really seemed to pick up. I want to say around 2010, 11 is when all of a sudden this seemed to really become a hot issue. So, that more than 10,000 cash and cash equivalents. Can you kind of describe what does a business have to think about? When does it have to report this? Because it can get a little complicated.
Definitely. And where it gets complicated are with consumer durables. But let's just talk like more generally first. Any cash, which is currency, that can be coins, gold, US currency, or foreign currency, that's used to pay for anything, goods or services in the connection with a trade or business, that's more than $10,000. But it can also include some other items. And one of the things that it can include, and this is where things get complex, is it can include monetary instruments, which that is defined as like a cashier's check, money order, bank draft, or traveler's check that has a face amount of 10,000 or less, right, that is received in a transaction along with cash or some other form of payment and used to purchase a consumer durable. And this type of transaction is called a designated reporting transaction. And a consumer durable is probably what you would guess. It's something that has a value that remains, that kind of doesn't depreciate and remains useful for more than a year. And so what they're trying to get at here is, just to use an example, I think, to make this more understandable. So a lot of people know about the 10,000 or more, the more than 10,000 cash reporting requirement. And they have a reason that they want to use their cash to buy something. It could be because they're money laundering, they have unreported cash receipts, or they're just a person who has a lot of cash in their own business and doesn't want to have to, deal with depositing it and all of that. So if these folks want to buy something that's more than 10,000 in cash and they don't want to generate a Form 8300 requirement, someone had the bright idea of like, we'll combine it. We'll use a credit card for 5,000. We'll go and we'll get a money order for 5,000 or for 6,000, and we'll go in and we'll buy an $11,000 watch. And it's a nice watch. It's a Rolex or whatever. And so it's going to retain its value forever. I could resell it for cash. I could trade it for something else. And that way I can do something with my cash and not trigger the 8,300 reporting requirements. And so after, years of having experience with people trying to come up with all of these workarounds, the IRS developed or Treasury developed regulations that basically deal with this issue. So if you're in a trade or business and someone comes in to buy something that would be a consumer durable, and this could also include travel and other items that can be resold easily, and they're doing some odd combination of a monetary instrument and cash and a check or wire, then that will also trigger the Form 8300 filing requirement.
So, let's talk about the car dealership, that case that I had, mm-hmm. the first case I had come mm-hmm. in. So if you're home listening to this, I'll walk you through it. The car dealership understood, right? I show up, I give $7,000 in cash as a deposit. I show up 3 days later with another 5,000. They report it, right? More than 10,000 mm-hmm. of cash. The dealership got that. Now I come in, I put down $7,000 in cash. I then come back a week later with $5,000 money order. That also has to be reported. Even though it's not more than 10,000 of cash, here's the way it breaks down. And I'll give you a third example, and then we can break it down for you. Third example is I come in with a money order, all right, for $12,000 and buy the car. you don't have to report that, because the money order that I got from a financial institution or one of those money places that issue money orders and cashier's checks, they have to report it if it's over 10,000. Therefore, the dealership doesn't have to. When I came in with the cash, with a combination of the cash and the money order that was under 10,000, right? Remember, I put down the 7,000 cash and then the 5,000 money order. That does need to be reported. It's more than 10,000, and the money order is less than 10. So the institution that cut it didn't report it. Therefore, they have to. And I and the auditor are trying to explain this to the dealership and their staff person, who was like, oh my God, because they didn't realize this. And at the time, I think it was, and this is years ago, $50 per violation. So they got like $1,200 of a penalty. And the owner said to me, oh, no problem, cut the $1,200. And I said, it's no problem now. If they come back in 2 years and this happens again, that's closer to 200,000. Because now all of a sudden, now you knew, and I thought it jumped. It was like 20,000 a violation. I mean, it jumped like, it wasn't even close. It went from like $50 to like 20,000, and we managed to scare the dealer pretty well. But so people know, if you watch The Sopranos, I don't know if you remember this point. She finds all the cash that Tony's been hiding out in the back in the birdseed or whatever. So she's running around to each financial institution depositing $9,995. And there's a scene where the person's like, well, it's good that it's not more than 10,000, because we'd have to report it. She's like, oh, really? Playing dumb. Most people know about the cash. It's the combination that I think people are kind of caught, a little bit off guard with. So if you don't mind, where are the penalties on this stuff now?
Mm-hmm. Yeah, the penalty provisions the penalty amounts constantly change. And so if you're a practitioner listening to this today and you have an 8300 audit, it's good to go back and look at what the penalty provisions are during the year that is under audit. And the IRS has all this information posted. They actually have a really good reference guide on irs.gov. If you just type in IRS 8300 reference guide, you'll get it. And it has this information by year. It'll tell you what the penalties are. But for 2020, for non-willful or non-intentional failure to file an 8300, the penalty is now $270 per return. Now, that may not seem like a lot, but for businesses that have a lot of cash transactions, it can add up. There is an outer limit to this, though. So if your business has gross receipts of more than $5 million, then the penalties cannot exceed $3,339,000 per calendar year. It's a very high ceiling, but at least there is a limit. If your business has gross receipts of not more than 5 million, the ceiling is $1,113,000. So those are very odd numbers.
Yeah, 1,113,000.
I have no idea why. This probably has to do with how much revenue they want to raise for different reasons. So they mess around with this amount of penalty because it's an easy place to be able to add to the bottom line. So that is something you probably just want to look up every time, because I don't know about you, but I can't remember those numbers. I can remember $270 per form. I will note, though, that, and this is a good practice tip, if you are working with someone and you discover that they're out of compliance, if you can get that form filed within 30 days, that penalty is dropped to $50 per form instead of $270. So, and those are for unintentional, just like negligent mistakes. For intentional disregard, which, as Eric mentioned, if you've had someone who's had a 3,800 compliance audit, 8,300 compliance audit before, and the IRS comes back, it's going to be really hard not to have intentional disregard penalties if they've continued whatever practice they were engaging in before. So for these, the penalty can be $550 per failure, or, I was looking at the wrong spot. These can be really massive, because it can be $27,820 per violation, or the amount of cash received in the transaction not to exceed $111,000. And there's no outer limit. So as many as you have, you could have that add up. So if you have, a lot of forms due and it's for large amounts, this can really be catastrophic to a business. And so that's the penalty regime for failure to file the 8300. There's another aspect of this we haven't talked about yet, which is that the business also has to send out to its customers an annual statement letting them know that they have filed the 8300 and they've reported the cash transactions to the IRS. And so there's a similar penalty regime for this failure. So if you don't send the annual statement, then the penalty is the same for non-intentional negligent failure to file. So that 270 per violation with those same ceilings, which I won't go through again.
It could become $540 for every transaction if you fail to send it to the client and you fail to report it to the government.
Mm-hmm. Yeah, exactly. And they will double up, and they do double up. There's not any sense of looking at what's, commensurate with the non-compliance or fair. If you didn't do both, you will get penalties for both. And so that can add up. And then there is, if you correct that, this is another little wrinkle. I mean, these rules are pretty complex. And so if you have 8300 issues, although you can learn a lot from this podcast, I do recommend that you go back and read the statute and regs and the IRS reference guide. So if you have a failure to furnish the annual statement, and you correct it within 30 days, it's also reduced to $50. However, if you correct it between that 30-day period and August 1st of the year, then the penalty is $110. And there are caps to these as well. The caps are for businesses with gross receipts of over $5 million, $1,669,500. And if your gross receipts are less than that, the ceiling is $556,500. So, but if it's intentional, then the failure to furnish comes up to $550 per failure, or if greater 10% of the aggregate amount of items required to be reported correctly with no limitation. So I know I rattled off a lot of numbers there. I think the takeaway is that these penalties can be very onerous, particularly if they are for intentional disregard. And we can talk about what that means if you're ready for that.
Well, what I think, and I do want to get into that. If you're someone listening saying, okay, the reporting of the cash, like, why is this such a hot button issue? And I was at the time, I forget her name, who was in charge of the BSA program for the IRS, but we had a conversation about this at an ABA conference, and she told me, maybe like in Connecticut where I am, it's not as big a deal. She said, but along the southern border, this is a major part of the fight against drug trafficking. Because if you're one of the Gulf cartels, or, how do you get your cash across the border? Well, if you can go into a Mercedes dealership, buy a Mercedes and drive it over the border and then sell the Mercedes on the other side, that's a great way to, get what would otherwise be, cash across the border. I always find it funny if you watch Casino Royale, the newer one, Bond, the $150 million, he's walking with the little briefcase. Like, yeah, there's no $1 million. You would need like one of those like rolling luggage suitcases. So 150 million, you'd need a bunch of Brinks trucks to try to move. So how do you do it? If you can buy Rolexes, get some diamond earrings, drive a Mercedes, in other words, carry or drive across the border. That's why it's such a hot button issue for the government to try to crack down on the movement of the cash. So let's get into the intentional, the reckless aspects, or frankly, those who are involved in crimes. Yes,
definitely. And I wanted to, as we get into that, also talk about what you mentioned before with the example from The Sopranos of her going around and trying to keep transactions under 10,000. And so what she was trying to avoid was the currency transaction reporting that the banks have. But people also try to avoid the 8,300 filing requirements in lots of creative ways. And so intentionally trying to do that is a crime. It's the crime of structuring. And so when we get to talking about intentional disregard and the criminal activity, I mean, that sort of behavior on both sides is going to be a big red flag for the IRS. And in addition to that, though, with related transactions, it's a way for the IRS to combat this structuring on the business side. So if a person comes in and spends more than $10,000 of cash in a 24-hour period, even if they're buying different items, those are considered related transactions that are aggregated, added up together, and then 8300 report is required. Also, if it's one item, like the example you gave of someone coming in a couple different times to pay for a car, but over a 24-hour period, then that's going to be considered reportable. So the customer's not actually avoiding the 8300 by breaking up the transaction. The form, though, if you have the listeners have time to take a look at the IRS form 8300, you'll note that at the top there's a place for the business to mark that it's a suspicious transaction. And this is wholly voluntary on the part of the business, but I think the IRS does appreciate it. And where it's suspicious is where it appears that the customer is attempting to cause a Form 8300 not to be filed. And so if you're advising business owners and they say, like, I'm just not quite sure, there isn't really, the cash doesn't quite add up, or there were so many different transactions over a long period, but I just have a bad feeling that they were trying to keep me from filing this form, then they should go ahead and file the form to report the transaction and mark it as suspicious. Note, however, if you do that, you're not required to furnish the annual statement. I guess the IRS doesn't need you to give a heads up to the person that you went ahead and reported them anyway.
Well, and what's interesting, people should realize there are severe penalties on the financial institution for the failing to file the 8300 or even the suspicious activity reports. I think it might have been Bank of America. One of the major banks got audited. One of the branches, there was a clear pattern, and the branch never, maybe they had flagged it, but never filed the suspicious activity reports. And it was a $250,000 fine. So, one is, if you're trying to avoid having it filed, you're committing a crime, as Megan said. But also do note that the institution has a real interest in, by default, if there's a question, they're going to file the form. And any major, I mean, maybe you could find some check casher you might be able to convince, but any major bank or branch or financial institution, casinos, any of them, they're going to file it, because when push comes to shove, the penalty on them is so severe, it's easier to file it and that you deal with it. And by the way, suspicious activity reports, if you mention them to someone at the government, which is just so stupid, but you mention it to somebody at the government, like DOJ or the IRS, no, we don't talk about that. It's as if they don't exist. And so I put up a chart when we did Criminal Tax Day a couple of years ago. I put up a chart on the filings of the SARS suspicious activity reports over a number of years, and the AUSA. You would have thought that I had somehow suggested everyone commit tax evasion because you can't. And I said to her, I said in front of the audience, I'm like, you do realize I got this off the DOJ website. I mean, I don't understand what the big secret is, but it's like kryptonite or something.
Yeah, I think they're afraid that if people sort of know what the financial institution's parameters are for filing suspicious activity reports, they'll try to plan around it. Kind of like the IRS doesn't want us to know how they select returns for audit, because they think that we're going to, do some shenanigans to avoid audit more than taxpayers already are doing. So anyway, we keep promising to talk about intentional disregard.
So let's talk about intentional disregard.
Yes. So this is where the penalties get really heavy, as we talked about. And intentional disregard is defined as knowing or willful conduct. And of course, this is a facts and circumstances analysis. And so the IRS has in the regulation certain types of facts and circumstances that it's going to consider in addition to just, the general types of things that it looks at for willfulness. And by the way, here in this context, intentional disregard has been equated to willfulness by the courts. And the definition of willfulness in tax is a voluntary and intentional violation of a known legal duty. So they had to have done it voluntarily. They had to have done it intentionally, and they had to have known at the time they were doing it that it was wrong. So those are the things that the IRS has to prove in order to get penalties at the level of the intentional disregard. But some of the specific things they're going to look at is the taxpayer's history. Is this a pattern of conduct? Do they repeatedly fail to file or file incorrect Form 8300s? What did the business do upon discovery of the failure? Did they try to self-correct, or did they just, let it go? And, whether or not the information reporting penalties is less than the cost of compliance. So what they're getting at there is, are businesses just blowing it off because they think that they'd rather just pay the $270 per form than and get that penalty rather than going through compliance. And so if your clients are thinking along those lines, that's a very bad fact if the IRS can prove it.
Right.
So
and people might say, well, how does the IRS prove that? Now, I didn't have it in the 8300 context, but I've had audits where accountants have turned over files, and in there are emails between them and the taxpayer.
Mm-hmm.
And if there's something, like the car dealership, for instance, where she emails the owner and says, should we file this? And the owner says, nah, I don't think so.
Yeah, that sounds like intentional. I mean, it's the way the IRS figures out anything. I mean, it's always the question that clients have when you're talking about penalties, either civil or criminal, that involve willfulness, like fraud or any of the tax crimes, really, and also structuring and all of the types of things we're talking about here for intentional disregard in 8300. They always say, well, how is the IRS going to know? Well, they know because there are indicia of fraud or badges of fraud and willfulness. You're behaving in a way that you wouldn't behave if you thought what you were doing was correct. And they'll figure it out, by talking to employees, by talking to potentially the cash paying customer, by looking at your systems, your books and records. I mean, honestly, if you're a business that has a volume of cash and you don't have any system set up for 8300 compliance, I mean, I think the IRS is going to say you're acting with intentional disregard, because everybody knows that you may not know the specifics, but you have a sense in your mind that there's something you're supposed to do if you get more than $10,000 in cash, and you don't even have a plan for that. And so that is a problem for businesses. Maybe if it's your first time you got the cash and you didn't ever have it before, but if you're getting cash all the time and you have no plan for reporting it or any procedure, and you're not training your staff, that's going to be a strong intentional disregard case for the IRS.
Well, what's funny is in the BSA audits we've had, the first thing they'll say is, do you have a training manual? Have you trained your people in this?
Exactly.
And for a while, and again, I hadn't seen them, but for a while, there were organizations running around offering prototype training manuals and online and in-person training if you wanted, for a fee. But they would come in and train and help you, design a manual so you could get through these audits.
Yeah, definitely. And that's one of the things for people who are advising businesses, to take, back to work from this podcast, is to, communicate with your clients and ask them, do you get a lot of cash in your trade or business? Like, let's talk about that. And do you have procedures in place? Have you looked at the Form 8300? Do you know that you have to ask for a identification and a taxpayer ID number when you're taking more than $10,000 in cash? And sometimes people are just genuinely surprised to learn about this. But once they know, then they have the obligation to be compliant. This is definitely not an optional form.
So listen, when it comes to the penalties, are there defenses?
Yes, there actually are. It's obviously easier to defend if what you're talking about is a non-willful failure to file. But some of these defenses may apply across the board. I mean, the first is if the error or omission on the form is inconsequential. So sometimes, the IRS, if you have an 8300 audit, will pick through the forms and the annual information statements, and they'll find something that's incomplete or not quite right, and they'll want to penalize that. But regulations, and you sometimes have to remind the auditors of this, do say that there should not be penalties if the error is inconsequential. So this isn't even just like a sort of like discretionary feel good thing. It's actually in the regulations. And so what does inconsequential mean? That's not defined, but they do define certain items that will never be deemed to be inconsequential. So you cannot use this defense if you failed to report the taxpayer identification number, the last name of the payee, or the amount of the transaction. Those are all consequential. But the inference you can draw from that is that all the rest of it, you could argue is inconsequential, such as the address of the person, or that you've gotten a copy of their identification and some of those things. Now, the IRS isn't going to, agree with that, but you can give it a shot. And I have a case right now where they didn't put the phone number of the person to contact on the annual information statement to the customers, and they're charging them a penalty for every letter. And it's like $200,000 because it's a business that gets a lot of cash, legitimately, just the nature of their business. And I'm just like, really? And I have to go to appeals on that because they won't agree. But to me, that's just right down the middle of the road, an inconsequential error or omission.
And this is the annual statement that goes to the taxpayer.
Right.
Their own phone number.
Go to the IRS. Yes.
So,
it's ridiculous. But anyway, also there's a reasonable cause defense. And so this one is, there's no penalty imposed if the failure is due to reasonable cause and not willful neglect. However, 8300 is an area where reasonable cause has a more nuanced meaning than it does generally. When we're talking about failure to file, we think of reasonable cause as being just ordinary business care and prudence, right? But for 8300, there's more to it than that. It's more strict. So the taxpayer has the burden of proving either that there were significant mitigating factors that excuse their failure to file, or the failure to file resulted from events beyond their control. And the mitigation requirement, if you're going to use that part of it, you have to show that you rectified the failure as promptly as possible, as soon as it was discovered. And they'll also look at your compliance history for that. For events beyond the taxpayer's control are, of course, going to be like, catastrophes, and those kinds of things. But interesting, it also includes the customer's refusal to reveal the taxpayer identification number. And I always think this is really interesting because people often ask me, if someone refuses to give their TIN, which is required to be reported on the form, like, what do you do? Can you just should you not do the transaction? And actually,
probably.
I'd say probably just ask them for another form of payment, but that's easier said than done if you're the person who needs that sale that day. So the IRS and Treasury actually have a little bit of pity for business owners in this area. So if the person refuses to provide their EIN, you actually do not have to stop the transaction in cash. You can still take the cash and you can file an incomplete Form 8300. However, the regulations then require you to do certain things to solicit the Social Security number or EIN after the fact. And so those regulations basically say you have to make the solicitation on the premises when you're making the sale, like ask them for it. And then after the sale, you have to send them another solicitation, basically before the end of the year, or if the transaction occurs in December, by January 31st of the next preceding year or the next year. You have to basically write them a letter and ask them to provide you with their EIN. So this means you would have had to get the customer's name and address for sure. But if they do refuse to give their TIN and you go through the solicitation, and again, this is one of those things where the rules are really technical. And so you should, if you have a client in this position, go back and read the regs, read the Internal Revenue Manual for specific information as to how to make the solicitation.
Right.
You have to say certain words and you have to do it in a particular way, send it by mail and all these things. But if you do that, then you won't be penalized for not reporting the taxpayer identification number on the form. So businesses should know there is a way out. They can make the sale if the person won't provide their TIN, but they have to know that there's a significant compliance burden after that. They have to remember to make the next solicitation, or that will be considered an incomplete form. and you won't be able to get out of it based on reasonable cause for that particular item.
So if the IRS does show up for this, is there a statute of limitations? I mean, how far back can they audit you for this?
Yeah, I mean, then this is where the difference between the audit being done under the Bank Secrecy Act or the Internal Revenue Code may make a difference. But in general, if the basis for the penalty assessment is failure to file or failure to furnish the annual information statement, then there is no statute of limitations, right? It's just like an income tax return. If you don't file it, the IRS has until the end of time to assess tax. I think it's interesting that for the annual information statement, that the IRS's position is that there's no statute of limitations on it, regardless of whether you sent it or not. I mean, that's never been tested in court. I would be willing to take on that case.
Yeah.
But if you did file and your penalties are being assessed under the Internal Revenue Code, then it's a 3-year statute of limitations for assessment, just the ordinary fallback rule. However, if it's a bank secrecy audit, then the statute of limitations is 6 years from the date of the transaction for which the penalty is assessed. So the IRS gets more time. I mean, how do they choose whether to do a BSA audit under the Bank Secrecy Act or the Internal Revenue Code? I think it tends to be that smaller businesses with just tend to be under the Internal Revenue Code, whereas businesses that are dealing in luxury goods, jewelry, cars, things along those lines are probably more likely to have an audit under the Bank Secrecy Act. But it's really within the IRS's discretion, and they have guidelines and policies that govern this. But they can make the audit under the Bank Secrecy Act just merely by saying so. There's not any there's no way to challenge that in court. You couldn't later say this should have been an Internal Revenue Code audit, not a Bank Secrecy Act audit. But be careful, because if they do assess a penalty that's out of the 3-year window for an incomplete failure to file the form, if they're doing it under the Internal Revenue Code, it's going to be time barred. They need to properly do it under the Bank Secrecy Act statute, but for whatever that's worth. But for most of the 8,300 cases, I find that it's failure to file as opposed to incomplete filing that the IRS is focused on.
I've never seen an incomplete filing. For me, it's been folks, and again, usually it's the combo purchase, a combination of cash and something else. Before we wrap up, and I ask how people can get a hold of you. Have you seen DOJ go after a business or people criminally for 8,300 or failing to do the?
Yes, absolutely. And if you'll all look, and I don't have the name of the case on hand, but it's easy to find. There's recently been an indictment of attorneys down south for failure to file 8,300s. They were receiving cash of more than $10,000 in their law practice. And so that's been in the tax press and the white collar press here and there over the last year because of that. And so, yes, there are criminal penalties for this. There's a special statute under the Bank Secrecy Act. That's section 5322, if you're interested. Also, under the Internal Revenue Code, you could be prosecuted under 7203 for just willful failure to, file a return or supply information. Also, if it's bad enough, you could be, also charged with, tax evasion, or if you're filing lots of false forms, 8,300, you could be charged, for making false statements under 7206. And then, of course, there's the structuring crimes under the BSA and the code. The BSA code section is 5324. And all of these are felonies and major offenses. And so that's something also to warn clients about, is that if they have a BSA audit and they get through it and they owe some, penalties for, basically the negligent failure to file, pay those and then get your house in order. Because if you have it happen again, that's when you get into the realm of the intentional disregard penalties in the criminal. And major training of the people who work at the cash register to understand these rules, and also to understand how to spot structuring and not to be complicit in it. Because I imagine it can be difficult when you're at the counter and someone's making a big sale and you maybe are going to get a sales commission, and they're putting the pressure on you to either assist them with structuring, not report, the designated reporting transaction with the consumer durable, or just not to file the Form 8300 at all. And so they need to understand that there's, consequences to that beyond just, not doing what your boss said that day, that this can be pretty intense.
Well, especially for attorneys, one is, and we've had people come in with more than $10,000 in cash that want to pay us, and we tell them, and inevitably they're like, that's fine, report it. And we have. The idea being maybe they'll go get a check and pay, and so we don't have to, but no. But the other concern I would think lawyers would have is, if you're getting cash, and especially if it's a criminal matter, the idea of having to disgorge fees if it's found that you're being paid from the proceeds of the crime. For those of you listening who don't know what I'm talking about, there's a whole line of cases where many of the federal circuits have said if the attorneys can't get paid from the proceeds of the crime. So if the client is prosecuted and they have restitution, that money that you were paid, guess what? You have to pay that back. So most lawyers, I would think, don't want to take cash from someone who's the target of a criminal investigation for fear of not. It's bad if the client goes to prison. It's worse if I don't even get paid for doing all the work and the client.
Absolutely. And someone coming in with more than $10,000 in cash may be a red flag.
Yeah.
It may also not be. I mean, that's the thing about all of this 8300 compliance. Cash is still legal tender in the United States. People have lots of reasons for wanting to use their cash. It's not always nefarious. I thought it was interesting because I had a client once who had an 8300 issue who was a plastic surgeon. And I was surprised by that. And he said, oh, goodness, I get so much cash in my business. It's like, why? And the reason for that, I don't want to offend any of the podcast listeners, that he gave is that sometimes, that people want privacy around certain kinds of cosmetic procedures. We'll just put it that way. And so they may not want it known that they're paying for certain things. They don't maybe want a spouse to see that something's been paid for, or other family members or whatever. And so the way to do it under the radar is to come in and pay in cash for your procedure. And again, that's just a privacy issue on behalf of his patients. It's not necessarily indicia of any kind of criminal activity or anything like that. And so I always try to emphasize that when talking with the government, that just because there's cash doesn't mean there's something wrong here. It might be, but there's lots of good reasons for people to use cash. But the important part for you all as practitioners is to really try to communicate and educate your clients about these issues so that they don't inadvertently fall into a long audit. These audits are painful and protracted, and the IRS is very quick to assess the maximum amount of penalties that they think they can do, and they aren't very sympathetic. I mean, the regulations provide all of these exceptions to the penalties, reasonable cause, mitigation and consequential errors, but the agents really are, I don't know sort of why, but they're really focused on penalties as opposed to education right now. And so you as a practitioner can help by giving the education so that you don't even have to be in that position.
Yeah, no, and we've had Damon Rowe and Darren Dio on, and Chief of Criminal Jim Lee's been on, and there's a real message coming. Chuck, who you and I know. There's a real message of fine fraud, and that is clearly, I think, filtered down to everybody, audits, collection. And so I do think that they've taken a much more hard-nosed approach to this, which, as we were discussing before, isn't necessarily always really, I think, appropriate. But that's kind of where, the pendulum is now swinging much harder toward enforcement. So Megan, listen, thank you. For the listeners who have an 8300 or frankly any issue who would like to get a hold of you, how do they do so?
You can find me on my firm's website, which is Kostelanetz and Fink. So it's just www.kflaw.com. You can call me. My phone number is 212-808-8100, or you can email me, and you can get my email off the website if it's too difficult to take down while listening. But it's M as in Megan, Brackney @ kflaw.com. And I'm always happy to chat. You don't doesn't have to be a client engagement. I'm happy to just talk through an issue or give advice to anyone who's out there in the tax practitioner community. One great thing about being a tax controversy lawyer is all the great friends and colleagues from other firms, including Eric. And so I'm always happy to make new friends in the tax controversy community. So always feel free to get in touch.
Yep. No, and I will put your email. I will put Megan's email in the description of this episode. So if anyone wants to shoot you an email or find you, they can do that. All right, Megan, listen, thank you for taking the time. This was a lot of fun.
Thank you for having me. I love talking about these issues, and it's always good to talk to you.
All right. And everyone listen, thank you for listening in. And of course, we'll be talking to you next week. But if you want to get a hold of Megan, her email will be in the description. And as always, thanks for tuning in. And Megan, again, thank you.
Thank you.
If you haven't already subscribed to the Tax Rep Network podcast, go to taxrepllc.com, mouse over resources, and click TRN podcast. You'll get an account loaded with all the episodes, our sponsor offers, and transcripts of recent podcast episodes. Thanks for listening, and thanks again to our sponsors, Call ENQ and Tax Help Software. See you on the next episode.